If you're waiting for mortgage rates to fall, this video might completely change the way you're thinking about the market. Over the last few months, Canadians have been told the same story over and over again. Rate cuts are coming and mortgage relief is right around the corner. But what if that isn't what happens? What if the next move isn't lower rate? What if the reason rates are staying higher has nothing to do with Canada's economy at all? And more importantly, what if some of the advice you're hearing right now about fixed rate and variable rate mortgages is missing a huge piece of the story? The narrative has changed. For most of 2025 and into early 2026, the expectation was pretty straightforward. Inflation appeared to be moving in the right direction. Consumer spending was slowing. Housing activity was weaker. Many economists expected the Bank of Canada would continue to moving rates lower as the economy softened. That was the consensus. But markets don't care about consensus. Markets care about risk. And over the last several weeks, we've seen a major shift in what investors are worried about. Instead of focusing solely on Canada's economy, investors have become increasingly concerned about geopolitical uncertainty, particularly the conflict involving Iran and the broader Middle East. That matters because one of the most important shipping routes in the world for oil passes through that region. Whenever there is uncertainty surrounding oil supply, oil prices tend to move higher. And when oil prices move higher, investors start asking an important question. Could inflation become a bigger problem again? Why oil prices matter so much? Many people hear about oil prices and immediately think about gasoline. But oil affects far more than what you pay at the pump. It impacts transportation costs, manufacturing costs, shipping costs, airline costs, agricultural costs, and eventually consumer prices throughout the economy. The concern from investors isn't necessarily today's oil price. The concern is what happens if elevated oil prices stay around for months. That's where inflation expectations can start changing. Businesses begin planning for higher costs. Workers demand higher wages. Consumers expect prices to continue to rise. And once inflation expectations become embedded into the economy, central banks have a much bigger problem on their hands. That's why bond markets have reacted so strongly. One thing I constantly explain to clients is that fixed mortgage rates and Bank of Canada decisions are not the same thing. A lot of Canadians hear that the Bank of Canada is holding rates or potentially cutting rates and assume fixed mortgage rates should automatically move lower. That's not how it works. Fixed mortgage rates are heavily influenced by bond yields, and recent bond yields have been moving higher despite softer inflation data. That's what's confusing many borrowers right now. The economic data says one thing, the bond market is saying something else, and that's creating uncertainty. Here's where I disagree with some of the headlines. I've watched a lot of videos recently suggesting that anyone who locked into a fixed rate mortgage made a brilliant decision and anyone with a variable rate mortgage is suddenly in trouble. Personally, I don't think it's that simple. As many of my clients know, I've helped a lot of people choose variable rate mortgages over the years. And I still believe there is absolutely a place for variable rate mortgages depending on someone's financial situation, goals, risk, tolerance, and timeline. Mortgage advice should never be one size fits all. The right mortgage for one family could be completely wrong for another. What concerns me is when people start speaking in absolutes. Fixed is good, variable is bad. That's rarely how real life works. Why the situation is different than 2022? This is probably the most important point in today's video. When rates were rising aggressively after COVID, inflation was being driven by a completely different set of circumstances. People were traveling again. Restaurants were packed. Events were selling out. Consumers were spending money everywhere. Demand exploded. Businesses couldn't keep up. That surge in demand contributed significantly to inflation. Today, that's not what we're seeing. Consumer confidence has weakened. Certain industries have experienced job losses. Many households are spending more cautiously. Economic growth has slowed. Housing activity remains soft in many areas. This time around, rising oil prices aren't necessarily being caused by consumers spending too much money. They're being influenced largely by supply concerns and geopolitical uncertainty. That's a very important distinction. Could rates stay higher? Absolutely. Could fixed rates remain elevated longer than many people expected? Absolutely. Could bond yields continue rising if geopolitical tensions worsen? Absolutely. Nobody knows for certain. But here's the other side of that conversation that often gets ignored. If tensions eventually ease, if oil supply concerns improve, if markets regain confidence, then oil prices could moderate. And if that happens, bond markets could respond just as quickly in the opposite direction. That's why I think it's dangerous to make long-term financial decisions based on short-term headlines. The Bank of Canada is stuck. The Bank of Canada is dealing with a very difficult balancing act right now. On one hand, the economy is clearly showing signs of weakness. Consumer spending has slowed. Housing activity remains challenged. GDP growth has been disappointing. Many Canadians are feeling pressure from affordability challenges. Normally, those conditions would support lower interest rates. But on the other hand, inflation remains above the bank's target. And now energy prices are creating additional uncertainty. The Bank of Canada doesn't want to stimulate the economy too aggressively if inflation risks remain elevated. At the same time, they don't want to make borrowing more expensive and risk slowing the economy even further. That's why they've chosen to hold rates. They're waiting for more clarity. And honestly, that's probably the most reasonable approach right now. The biggest mistake Canadians are making, the biggest mistake I see isn't choosing fixed and it isn't choosing variable. The biggest mistake is trying to predict the future with certainty. I've been in the industry a long time. I've watched economists miss forecasts. I've watched banks miss forecasts. I've watched experts miss forecasts. Nobody consistently predicts interest rates accurately. The people who tend to make the best decisions aren't the ones trying to guess where rates will be 6 months from now. They're the people who build a mortgage strategy around their own goals. Can they comfortably afford the payment? Does the mortgage fit their timeline? Do they value stability? Do they value flexibility? What happens if rates move higher? What happens if rates move lower? Those are the questions that matter. What homeowners should focus on right now, whether you're buying, refinancing, renewing, or simply trying to understand what's happening in the market, I think the focus needs to be on preparation rather than prediction. The market is uncertain. The economy is uncertain. Geopolitical events are uncertain. But your mortgage strategy doesn't have to be. Make decisions based on affordability. Make decisions based on your financial goals. Make decisions based on your comfort level with risk, not based on what headline says rates might do next month. The story right now isn't that fixed rate mortgages are winners and variable rate mortgages are losers. The story is that uncertainty has returned to the market. Oil prices matter. Global events matter. Bond markets matter. Inflation matters. And all of those factors are interacting at the same time. Personally, I believe a lot of what we're seeing today is being driven by geopolitical uncertainty rather than strong consumer demand. If tensions ease and stability returns, the conversation could look very different several months from now. Of course, nobody knows exactly what happens next. I certainly don't have a crystal ball. This is simply my opinion based on what I'm seeing in today's market. But what I do know is this. The economy is a little volatile, and making the right decision is key for your financial stability. Thank you for listening. This is Rasha Ingrata, Mortgage Agent Level 2 with Mortgage Intelligence since 1999 here in Windsor, Ontario. Thank you and have a wonderful day.